Good morning, everyone. Greg Taylor here from Solder Brothers. We'll just wait another 30 seconds or so and give everyone a chance to join the meeting, and then we'll make a start. Okay, look, we'll make a start. As is always the case, a recording of the presentation will be provided for people who potentially missed the start or are unable to attend today. So, yeah, and a copy of the presentation has been released to the ASX this morning also. All right, well, thank you again for everyone taking the time to dial into today's webinar on Solder Brothers Emerging Company Limited, which is under the ASX code SB2. This is part of our regular webinar series, which we do on a monthly basis, providing investors with an update of portfolio performance, portfolio positioning, and any topical matters that might be influencing the broader markets or the portfolio at any point in time. You've got your standard disclaimer there, which again you can read in your own time. So if we jump over to a bit of an overview of what we'll cover today. So this is effectively the monthly report and webinar for the month of August, which included the key reporting period for the ASX listed companies. So what we'll do a bit of a review from a macro level on what were the observations from the reporting season, and then I think off the back of what we did in the latest webinar, we'll do a bit of a deep dive on a couple of the key portfolio holdings, and once again we'll have both Frankie and Dane available to take us through those key positions. Will highlight, I spoke about it previously, but some key developments with the unlisted holdings in the portfolio that could be quite a meaningful contributor to performance over the coming period. All right, we'll jump into it. So just to recap again from a bit of an executive summary perspective. Remember, Solder Brothers Emerging Companies Limited is a dedicated small cap portfolio focusing on companies with a market capitalisation of under 500 million. You now have well over a 4-year track record since the fund was launched, and consistent strong performance during that period. Investors might recall we had a very strong month in July when a lot of our companies released their unaudited financial results, and the strong performance was retained in the month of August. Well, the portfolio is relatively flat, though again that's a pretty good achievement considering the strength of the month prior to be able to hold that gain. And then just we'll touch on again at the back end of the presentation, but just a recap on the current discount to underlying post-tax NTA, still persisting there around that mid-30s, 34%. So again, we'll talk to a couple of potential catalysts on how we're looking to address that. So if you jump over the slide, we'll just start with a bit of a recap of the reporting season, and it was actually quite a tough reporting season, and most people will have reflected that as well. There wasn't many upgrades, and there was quite a few downgrades. So I think the general sentiment was that probably the broader operating environment for the underlying companies was balanced, but yeah, definitely was hard to find those big winners. And where a lot of the gains came in the month of August was in the resource sector, especially the small cap resource sector, which again delivered north of 13% positive performance just for the month. Investors will note that SB2 does not invest in the resource sector, so we obviously didn't participate in that upside over the month, but what you saw was your lot more stable performance across the small industrials. One thing we're pointing out here again, and feel like a little bit like a broken record, but just once again highlighting the valuation differentials between ASX large caps versus small caps. So again, the discount between the two is still at 20-year plus extremes, and meaning that the large cap market in Australia is trading at all-time records and premiums to that of the small cap. And what's shown here is that the forward PE ratio of the ASX 200, which is a barometer for large cap Australian equities, is at historic highs, up to about a 22 times PE. So it definitely looks like the upside for that end of the market gets more and more difficult, whereas again the small cap market remains below long-term averages, and again at a significant 20% plus discount to the large caps. And then, as we've shared in previous presentations, that at different times of the cycle, small caps do trade at a premium to large caps because of their superior growth profile. So whether that happens again in the near term's less certain, but I definitely think there's a bit of mean reversion that is likely to occur, especially in light of the continuing decrease in the interest rates that's happening not only in Australia but globally as well. So, which is really positive for small cap valuations. So, pretty stable operating environment, extreme differential, and some positive catalysts. It's only a matter of time until that gap closes, and that's why we continue to be very optimistic about the outlook for small caps, and especially relative to Australian listed large caps. All right, jumping over the page, we're going to dive into a couple of key holdings in the portfolio, and so I'll hand over to Dane Grant, one of the key analysts in the team, to talk through our investment in Symal Group and why we've increased that to be now a top 5 holding.
Hello. Just talk on this, turn it off. Sorry about that. I'll just use Greg's microphone here. So yeah, I'd just like to talk through Symal today. As Greg mentioned, it's one of our new top holdings, which we think had a good update during the reporting season. So Symal is a founder-owned and led construction contracting and equipment hire business that IPO'd late last year, but it was originally founded in 2001 as sort of a residential landscaping business, and today has grown to a large, high-quality, diversified construction business. Their civil construction segment remains the largest contributor to group earnings, operating in civil and private infrastructure, energy, defence, data centres, further engineering and design support. In FY25, this segment earned 58 million in normalised EBITDA, and we quite like this segment due to its sort of strong record of organic growth and Symal's group's ability to consistently select and importantly deliver on profitable jobs. An important aspect to this Symal's model is that they operate at sort of 50% subcontractor roles and 50% higher margin head contractor roles, which provides them greater flexibility around their own workforce and projects on hand, which allows them to maintain consistent profitability in that segment. Simul's second key segment is their plant and equipment hire business, where they own and lease out excavators, graders, dump trucks, rollers, bulldozers, and lots of other construction equipment. In FY25, this segment reported a normalised EBITDA of 44 million. And similarly, this segment has demonstrated strong organic growth, including which should continue with significant investment in FY25. And again, we like the flexibility that Simul has built into this business to maintain high utilisation rates of around 80%, with a focus on operating at a level where 50% of the equipment owned by Simul satisfies 50% of Simul's group's internal equipment demand, with the remaining 50% of equipment owned hired externally, allowing optionality to internalise more gear should the broader hire market experience a downturn in demand. Also, just talk about Cycle Quickly, which is a newly established segment in Simul, focused primarily on the recycling of construction materials. And a significant portion of Simul's current and future growth capex is targeted on this segment, building out additional input capacity, but importantly expanding the group's ability to lower landfill costs by generating a greater portion of saleable outputs. We expect this segment could contribute meaningfully to earnings in the longer term. But during the update, our conviction in the name grew with Simul's strong outlook, with work in hand, or their total contracted work, up 35% to 1.76 billion. And importantly, 800 million of this was contracted for FY26, which is significantly above what they held at the start of FY25. It's important to note that throughout each financial year, Simul has demonstrated consistent ability to win what they call get and do revenue, which is just revenue that they win throughout the financial year. And on the average, in the last sort of 5 years, they've typically won 400 million per year. So with that, and with a growing pipeline, we have continued conviction in Simul. And what also supports that is just the progression of ECI projects through Simul's pipeline, which is where Simul, in their engineering and design support, will consult the projects, and they've demonstrated a 90% conversion rate on the opportunities that sit in that pipeline. So with this accounted, we believe their guidance of 115 to 125 million EBITDA does look attainable. And then over and beyond that, Simul remains in a very strong balance sheet position with a net cash of around $40 million. So it should provide additional optionality for inorganic growth. That's most of it.
All right. Thank you, Dane. And what we have at the top right, there's the price as at the end of August, but the portfolio built their position, the share price below $1.70. And again, trading on single-digit earnings multiples with double-digit projected growth with a strong balance sheet and some strong thematics behind it. We definitely think this could be quite a meaningful contributor to the next 12 months' performance. And you might note that Dane presented on Alfab's AAL last month, which turned out to be our best performing stock in the month of August and continues to perform very strongly. So this different business in many respects, but a lot of the fundamentals are somewhat similar. So really think this is an interesting one going forward. All right, thanks again, Dane. I'll pass it on now to Frankie Croswell, who's going to take you through Alcidion, which is been medium-term holding in the portfolio, but some really interesting catalysts ahead.
Thanks, Greg. Yeah, as mentioned, the investment case for Alcidion. So Alcidion delivers an enterprise health platform built around its flagship My Precision solution, which aggregates clinical data into centralized dashboards, supports interoperability across systems, and provides decision support at the point of care. The platform helps hospitals and health systems reduce emergency presentations, streamline clinical administration, and enable safer, faster discharge. With modules spanning command centre and patient flow, mobile clinical communications, remote monitoring, and electronic patient record capability, with deployments across the NHS in the UK and major health networks in Australia and New Zealand. Salter Brothers initiated a position in November of 2023 at an average entry price of 5.5 cents, and Alcidion went on to be the top contributing position in FY25 for the SB2 fund. FY25 marked a step change in execution with record financial and operational results as revenue rose 10% to $40.8 million and underlying EBITDA swung to a positive $5.1 million, an improvement of 8.5 versus FY24, and operating cash flow was $5.8 million. The total new TCV reached $73.8 million, driven by major contract wins and expansions with Hume, Peninsula Health, Narlan, NT Health, and Hildar, and the landmark 10-year North Cumbria NHS electronic patient record contract valued at more than $39 million. With Alcidion closing FY25 with a strong cash position of $17.7 million and no debt. Alcidion enters FY26 with $34 million of contracted and renewal revenue already locked in, its strongest ever starting position to date. Historically, the business has added an average of $10.6 million of in-period revenue each year over the past 5 years, and aligned with public sector procurement cycles where budgets are typically committed to by March, Alcidion has a credible pathway to incremental wins to layer on top of the already contracted base. Looking ahead, management is targeting continued EBITDA positivity and positive operating cash flow in FY26, while reviewing opportunities to extend the Maya platform into adjacent verticals such as aged care, community care, and is also advancing international expansion with market testing and partner discussions underway in Canada and the Middle East, while building on referenceability to deepen penetration in core markets and actively assessing selective M&A opportunities to accelerate growth. Strategically, Alcidion's dual positioning, either as a modular platform alongside incumbent vendors or as a comprehensive enterprise solution, broadens its addressable market and accommodates varied customer budgets and digital maturity. With recurring revenue compounding, record contract momentum, and new market expansion with restored profitability, Alcidion is poised for continued operating leverage and cash generative growth through FY26. That sums up the investment case for Alcidion, so I'll hand it back to Greg.
Thanks, Frankie. And as you touched on, it has been a good performer for the portfolio and reached highs, north of 12 cents a share from, again, an entry price of 5.5 cents. So at that time, we did trim our position a little bit and took some money off the table after more than doubling the value of the position. But since then, just off the lack of any new news flow, the stock's drifted back below 10 cents, and we think creates quite an interesting opportunity with some really important catalysts on the horizon, which most likely will be new contract wins. And what we've seen is, off these events, especially with the strong base it's got, it could result in a further significant positive re-rating of this name. So thanks again, Frankie. That was really helpful. So I'll slide on now to the next page, which I'm going to touch on the unlisted holdings within the SB2 portfolio. So pretty consistently, the unlisted portion of the portfolio is been sitting around 15% of the total fund. And just for clarity, these are private companies that the fund holds an investment in. In each instance, we hold a board position in these companies and actively manage them through their growth cycle and ultimately to an exit. What is very encouraging is that of the 15% of the portfolio, they're mainly split across the four names you see on this slide. So you've got IPSI, which is a fintech business, and then Pelican Corp, which is a sort of asset protection software business, global business. They're absolutely the two larger positions in the unlisted component of the portfolio. But then you've also got Sphere, which is it's a fintech around CO2 offsets, and then Bike Exchange, which was formerly an ASX listed company that was privatised and taken off the ASX sort of 18 months ago, and is working towards an exit in the next 12 months. But what I can say on each of these instances, that each of these companies are currently in a formal process for sale. So that means an advisor's been appointed, an external advisor's been appointed, and we're in active conversations with potential suitors for these businesses. And in many instances, or in more than one instance here, those discussions are quite advanced and are down to sort of exclusive processes and term sheets. So, in the event that a sale is agreed and documented, would result in a release of these holdings for cash. And the discussions to date have been that each of these conversations, the potential value realisation is significantly above the current holding value in the SB2 portfolio. So, I flagged this at the start of the year. There has been quite considerable progress on each of these over the course of the year, and still of the view that at least one, if not more, are likely to transact this calendar year, and based on current conversations, would be at a meaningful premium to the current holding value. If this was achieved, there's opportunity for anywhere between 10 to 20% upside from this cohort of holdings in the fund, and would also release meaningful cash. So just wanted to keep people abreast of that, and obviously if and when we do get to a resolution on any of these processes, we will update the market. But it definitely adds to the attractive risk versus reward profile of SB2 once you couple that with the discount to the NTA, which is based on a very conservative valuation for each of these businesses. I'll jump over the slide, please. This is just the standard portfolio positioning slide we put in every month, and what you see there is a couple of changes and new names in the top five. We've never spoken about Worker recently, and also Simmel Group today. And again, our Fabs and AI Media have had very strong recent performance, and BBT, which is Better Entertainment, is working through a couple of M&A opportunities itself, and creating a bit of noise on the share price, but fundamentally it's a very cheap stock that's very well positioned strategically, both organically and inorganically, so we retain our conviction there. But despite good performance by the fund and the improving market, the fundamentals and metrics still remain very attractive. The weighted average upside in the fund is well north of 70%. We've constructed a portfolio of circa 25 holdings, which on average are growing north of 20% top line, are highly profitable, and very conservatively valued. So again, retain great conviction on the medium-term outlook for the fund. And then just jumping over to the final slide, which is just around the discount, which I retained was confirmed was still in that mid-30. What we announced was an annual dividend for the portfolio. It was an 85% franked dividend. The only thing preventing it from being 100% fully franked was we have the franking credits, but just the profitability of the fund on realised investments capped it at the 85%. So we conservatively did that, but very much expectation is for ongoing franked dividends, which on the current value is close to a 6% dividend yield. The other dynamic we've seen is around the share register. So there had been a complete sort of recalibration of the share register with a number of long-term historic investors exiting the register, and we've rebuilt those with more aligned, fundamental investors, and that we're largely through that transition, which I think will really improve the demand and supply mechanics of the fund. Another development is we did get the fund independently rated by SQM. Got a very favourable rating of 4 stars, which a copy of that report's available on our website and platforms, or if you would like a copy, please feel free to reach out directly. And so that is raising the awareness and broadening the investor universe for SB2, definitely within that wealth management and advisor channel. So hoping that will generate more interest going forward. And again, we're continuing the ongoing marketing efforts. And then I think just over the page, we do have the summary of just that. There's a link there in the deck, which takes you through to the portal to view the detailed research report from SQM. So that's all we had for today, right on time. Again, encourage any Q&A either on the call or following the call by contacting myself or a member of the team. And if you had anything pressing, you can put it via the Q&A function in the chat now. But from what I can see, Megan, it doesn't appear to be any questions at this stage. Is that correct?
No, I haven't seen anything.
Okay. All right. Well, thank you again, everyone, for your time. But thanks again to Frankie and Dane for their valued input, not only with the presentation today, but with the overall portfolio. And we look forward to providing further updates in the next monthly webinar, but also if there are any events with respect to those unlisted holdings in the coming months. Thank you again. Goodbye.